Okay, let's record 9 transactions. Let's use debits and credits, and the information about each transaction will be in this center block, and the accounts are going to be all around this page. So here we go. Max Dexter, owner, invested $19,250 cash in the company. So we're going to debit cash for $19,250, and we're going to credit capital for $19,250. And the rules of debit and credit say that when you debit cash, it increases it, and when you credit capital, it increases it also. So both sides are going up at the same time. Let's look at the next one. Oh, and by the way, here's the same entry. Instead of doing it in a T account, we're going to do it in the journal form. So here's a debit to cash for $19,250, credit to capital $19,250. Now let's go on to B. The company purchased office supplies for $558 cash, so we will credit cash, which lowers cash by $558, and we will debit down here office supplies, and that debit increases office supplies. All we've done is trade cash for office supplies, and the overall accounting equation hasn't changed any. That is, assets have stayed the same. So to show this entry in a journal form, we'll debit office supplies and we'll credit cash for $558. Part C, company purchased $10,645 of office equipment on credit. So we'll debit office equipment for $10,645. That increases office equipment, and we'll credit accounts payable for $10,645. And this entry increases accounts payable. It also increases office equipment with a debit, increases accounts payable with a credit, and the entry's in balance. Now let's look at it in the journal form. Journal form, a debit to office equipment, credit to accounts payable. Let's go on to Part D. Part D, the company received $2,271 cash as fees for services provided to a customer. Looks like I need to turn that into black type down near the bottom there. So if we did that for a customer for cash, we will debit cash for $22.71. That increases cash, and we will credit fees earned, which is a revenue account, for $22.71. Cash is going to go up with a debit, and fees earned are going to go up with a credit. And here's the same entry in a looks like a journal form. So we'll debit cash for $22.71, and we'll credit fees earned for $22.71. Let's go on to E. Part E, the company paid $10,645 cash to settle the payable for office equipment purchased in C. So back in C, we debited office equipment and we credited accounts payable. Now we're going to pay off this accounts payable. So we will credit cash for $10,645, and that lowers cash with a credit, and we will debit accounts payable for $10,645. This also lowers accounts payable. So both sides went down by $10,645. Excuse me. And right now we have a zero balance in our accounts payable account. Let's go on to, and here's the journal entry, a debit to accounts payable. By the way, the debits are always first. You always do debits first and then indent a little bit and put a credit. So let's see, we've got a debit to accounts payable and a credit to cash, and I lost my cursor for a second there. Credit to cash for $10,645, and now we're ready to go on to F. Transaction F, the company billed a customer $4,081 as fees for services provided. So in this one, we've done the work for somebody, and we haven't collected the money yet, and we can put this down because of the revenue recognition principle, because we've actually done the work even though we haven't got the money. It doesn't really matter when we get the money. All that matters is, did we provide the goods or services, and we did. So our entry will be a debit to accounts receivable for $4,081, and that debit to accounts receivable increases accounts receivable, and we will credit fees earned for $4,081, and that increases the revenue account called fees earned. And here is the journal entry. We have a debit to accounts receivable and a credit to fees earned, and we're ready to go on now to G. In G, the company paid $515 cash for monthly rent. So let's credit cash for $515. That lowers the cash account with a credit. Let's debit rent expense, and this debit to rent expense increases the rent expense account, but it lowers owner's equity. So both sides are being lowered. The asset side's being lowered, and so is the owner's equity side, because anytime you have any debit to any owner's equity account, that lowers owner's equity. Again, any debit to any owner's equity account lowers owner's equity, and any credit to owner's equity to any owner's equity account increases owner's equity. So what we've done is we've lowered both sides. Assets went down by $515, and so did the owner's equity portion went down $515. Now let's show the journal entry. We have a debit to rent expense for $515 and a credit to cash for $515, and we're ready to go on to H. In H, the company collected $1,714 cash as partial payment for the accounts receivable created in F. So back in F, we debited accounts receivable for $4,081, and we credited fees earned for $4,081, and now we're collecting part of it. So to collect part of that, we were going to debit cash for $1,714, and we're going to credit accounts receivable for $1,714. This debit to cash increases cash. This credit to accounts receivable lowers accounts receivable. Overall, assets didn't change, and really nothing changed. So we just got some money in for an accounts receivable. So the journal entry will be a debit to cash for $1,714 and a credit to accounts receivable for $1,714. And we're ready to go on to I, which is the last transaction. In I, we have Max Dexter withdrew $1,100 cash from the company for personal use. So again, a withdrawal is not an expense of the business. It's just the opposite of when the owner puts money or equipment into the business. So back in the very first transaction, we debited cash for $19,250 and we credited capital. This is just the opposite. And we could, I think I've said this before, we could have in this withdrawal account, we could have credited cash for $1,100 and debited the capital account. And there's really technically nothing wrong with that, except it's better to keep track of it in a separate account. So we're going to keep track of it in this withdrawal account, and so instead of debiting capital, we're going to come over here and debit withdrawals for $1,100. So again, this withdrawal account is debited and it is increasing that account, but that debit will decrease owner's equity. So owner's equity is going down with this transaction, and cash or the assets are going down with this transaction. So both sides are going in the same direction, which is down. Okay, so the journal entry would be a debit to withdrawals and a credit to cash. Now, we've done all the transactions, so now it's time to put together a trial balance. And this trial balance, we're gonna add up all these accounts, their balances, and come up with one debit or one credit balance, and then we're going to put this on a little trial balance format to see if it balances, so that if it balances, we're ready to put together financial statements. Again, the whole purpose of this is to make sure everything's okay for this trial balance, that is, before we actually put together our financial statements. So let's see, the cash account, if you add up all the debits and add up all the credits and combine them, you should end up with a debit balance of $10,417. And there's my cursor right there. I lost my cursor. Now the accounts receivable account, that's going to have a debit balance, a net debit balance of $23.67. Let's see, we've got office supplies next, $568 debit balance. Next, we've got office equipment. It's going to have a debit balance of $10,645. The accounts payable has a zero balance, and any account that has zero balance, excuse me, you don't have to put on the trial balance. You do not have to put it on the trial balance, and so I'm not going to. Let's see, capital account, it's got a $19,250 credit balance. Looks like withdrawals has a $1,100 debit balance. My cursor's disappeared again. Okay, there it is. My fees earned account has got a credit balance of $63.52. And it looks like my rent expense has got a debit balance of $515. And now let's start putting some of these totals on here. So the cash accounts first. It'll be $10,417 rather. Accounts receivable, $23.67. Supplies will be $558. Equipment, $10,645. Capital has a credit balance of $19,250. Withdrawals has a debit balance of $1150. Fees earned has a credit balance of $63.52, and rent expense has a debit balance of $515. We're going to add up all the debits, add up all the credits, and hopefully everything will be the same on both sides, hopefully. So when you add all the debits up, you should get $25,602. When you add all the credits up, you get $25,602. And I believe we've just done a series of transactions and then prepared a trial balance. And now we're ready to do financial statements. So I believe we're at the end of this problem.